guys, we will start in a minute or two. Just let's get going on this and let's talk about what's happening in the markets of late. What's happening in the markets of late is they just keep going up.
Okay.
Normally the summer rally ends around May 5th, right? The seasonally strong period of time. It runs around May 5th, May 6th. We're a month after the market just keeps chugging and chugging and chugging. And what we're going to talk about today is what's going on in the fund and what do you do in a low volatility environment like we're in now. We've been mired in a low volatility environment since the end of October of 2023, and it's now June of 2024. That's like 7 months, 8 months that we've been at some really low volatility. And what that means is there's going to be a pullback. There will be a pullback. And it could be a sizable pullback. One bad piece of inflationary data, something along those lines, and all of a sudden the market turns, right? And especially considering we are done with the favorable period of time in terms of seasonality, it's high likelihood it could be happening pretty soon. But regardless, the year of an election like 2024, those are generally pretty good years. So let's begin, Matthew, okay?
Yeah, let's begin. So thank you so much for joining us, guys. So this is the Theta Alpha Fund update. And we are joined with Omar Khan and myself, Matthew Todman. Just to be very clear, our investment fund manager for this fund is Quarton Capital, and both Omar and I are dealing representatives for Quarton Capital. We're going to give you a little bit of a fund update here, right? So our agenda here, it's been a long time, Omar, a low volatility environment. And we're gonna talk about how we are managing in a low volatility environment. What are some key things to look for that we feel are important when trading in a low volatility environment. Then we're going to go over some of the outstanding positions and what we see on the horizon over the next few weeks. All right, let's go to the next page here.
All right, let me go on. Okay, so current market thing, managing a low volatility environment. Like we talked about, we've been in a low volatility environment since the end of October of 2023. Now, it goes back to what Warren Buffett says. When others are fearful, be greedy. And when others are greedy, be fearful. We're in greed right now. There's a lot of greed out there, okay? So we're in a low volatility environment, and the stocks that have really propelled the market are your Microsofts, especially NVIDIA, Alphabet, Apple to a lesser extent, not so much Tesla, but these are people gravitate towards the larger cap names, and there's really what's been leading the market. Now, there's a risk-return trade-off here, okay? The higher the market runs and lower volatility goes, the less we're being paid for options. So we're not going to be super aggressive in writing our puts right now. Why? Because we are anticipating a pullback. We're going to have a slide here that shows volatility. Right now, volatility fixed is hovering around 12.8. Now, the mean is 16. It's been around 11, 12, 13, 14 for 8 months now. So at some point in time, it's going to pop. And when the markets pull back, volatility goes up, which means options pricing goes up. And we know that 2024 is generally a good year, meaning the year of an election year, especially in anticipation of a Republican president. In this case, perhaps Donald Trump. And we don't get into politics, but that's viewed favorably from a market perspective. So we're going to be evaluating our risks here. We're going to be selective. We're going to get into positions because we believe there'll be a pullback. June, July, August, and especially in September and October. Those are the 2 worst months of the year, and they're right on the horizon. The markets have had a really, really good start in the first half of the year, and we are looking for a pullback, and that is when we're going to get more aggressively invested in the portfolio, okay? Many stocks are at the upper end of their range in terms of their Bollinger Band, so they're 2 standard deviations out now, right? And that doesn't happen very often. It only happens about 5% of the time. So a lot of these companies are at the upper Bollinger Band. They're really pushing 2 standard deviations above the mean, above the moving averages. And we got a problem here. We know what happens there. The stocks just don't keep running up and up and up and up and up. They do pull back. And the higher they go up, the less of an event that is needed to make that pullback happen. So something small could happen. One bad inflationary piece of data comes out. One good jobs number comes out, and all of a sudden the market says, well, the Federal Reserve might not have to cut rates. So today, which is Wednesday, June the 5th, what drove the market today? What drove the market today was really bad Jobs numbers come in at 152,000, much lower than expected. No, that doesn't make sense. That's not a bad thing. Well, it's not a bad thing because that gives the Federal Reserve more reason to perhaps cut interest rates. Interest rates are still elevated. The Bank of Canada cut interest rates by a quarter point today. The Federal Reserve in the United States has not cut it because they haven't seen enough bad data. Today's job data was bad data, not great. And then the market says, well, wait a second. The Federal Reserve has to cut interest rates. That is particularly good for technology stocks, okay? Low volatility environments are generally a precursor for market spikes. So we expect something to spike up. And we don't know exactly when, but we're being cautious, okay? We're still making some pretty good money. We're trading way out of the money, but we're being cautious. We've made some pretty good money so far, but we don't want to go all in until we get a good and nice little pullback here. The great thing is, thanks to you guys and also our partners at RBC now as well, we're starting to get some pretty good funds coming into the some good assets coming into the fund, which is great. We only want to sell strikes at prices we like. So we want to be able to buy stocks. Now we do analysis on every one of our companies. We know exactly the range, what we expect these prices to be. And again, that doesn't always work out, but we have a range on the low end, on the upper end, where we expect these stocks to be. So we're not just going to chase them up as the market becomes more and more irrational and just keeps running up and up and up. We're going to wait selectively and wait to be able to get into our positions because we are not in this for a day, a month, a week. We're in this for many, many years. So we want to get into the strike prices that we feel comfortable owning these companies at. And if that requires a pullback, then we'll wait for that pullback. But we are making some money in the meantime, okay? Now, here is a graph showing how low volatility has been, okay? This goes all the way back almost to 2021. Actually, it goes all the way back almost to where COVID. That's, you see that big spike around 80 in the far, far left-hand side. Look where we are right now. Look at since October. Since October, when the market, really started its rally, it was around 21, and it's been hovering super low ever since. So you can see, look where that green line is. That's kind of where the average is, because volatility on the index generally is a bit higher. So in this time frame, it's been 21.96. Now that does take into account what happened during COVID, but even at 16, we're still far below that. We haven't really had a big spike in volatility. We had a little bit in April, but we haven't had a spike in volatility, which means there's no fear in the market. You need to have fear. It's healthy for the market to have fear. At some point in time, there will be fear. There will be an excellent buying opportunity, and that is when we will get more aggressive. And like I said, the great thing is we continually have new money pouring in, so we are continually able to buy lower and lower and lower. But we have a fair bit of cash right now waiting in anticipation of this market correction that we believe is inevitable and somewhat hopefully soon as well. Matthew, anything to add here?
Yeah, I mean, it's as you can imagine, you guys have all traded options previously, guys. And it is just very difficult. And the key thing is just the uncertainty of what happens next, right? And if you, as I said before, if you can line up the good things in this economy, or the good things that could impact the economy, and the bad things that can impact the economy, you know what, like in the United States is actually a little bit different from Canada. Like that divergence is getting a little bit steeper, but we can talk about the United States, and and the end result is just becoming less uncertain or more uncertain, right? And now we have a very comfortable level. Like this is showing us that this type of chart shows us that the greed scale is getting pretty high there, right? Pretty high on that greed scale. And we have seen in our personal experiences that when this happens, that yes, there is a tendency for markets to pull back. The key thing is we just don't know when, because no one can predict when, right? You can have an idea, you could have it this year, next year, but no one really knows for sure, right?
But Matthew, the odds are certainly on our side, being the end of the favorable period of time, low volatility environment, lots of greed out there. The odds are certainly tilted towards.
There's lots of things that can go wrong.
Lots of things that can go wrong right now, and we're waiting for that, guys. Not that obviously we want to see the world collapse or anything. We certainly would like a little bit of pullback here. Volatility goes up, we get some really good premiums, and we're able to buy into some of these companies that are cheaper priced in anticipation for a good latter half of the year and hopefully a strong economy and a strong stock market as the Republican Party most likely is the one going to be in the Oval Office. Okay.
Yep.
Next slide here. So let's take a look at our current exposure. We got Alphabet. We're a little bit underexposed. Amazon, we're pretty much exposed as we want to be. And one of the things we're really looking for Amazon is their Amazon Web Services. It grew 17% year over year. It's really starting to grow, and they're the #2 market leader in web services, in cloud computing and cloud storage space. This, we know, is an area of massive growth. It's expected to grow 5-fold in the next 8 years, from roughly a global expenditure of $500 billion to $2.5 trillion over the next 8 years. So Amazon is one of the companies that is going to benefit from this tremendously. Also, Alphabet. Alphabet is #3. They are also going to benefit from this tremendously. So we're trying to get in these positions, but we don't want to chase these companies. Apple's introducing a new phone that is going to have probably, because a lot of us use Siri. Siri is pretty useless unless you want to know the time or what the weather is outside. It's pretty useless. But imagine a Siri that actually is pretty good, that actually works, that has real AI, something that you can talk to back and forth, have a decent conversation with, ask it to do something, it'll do it. Well, that iteration of phone is right on the horizon, and the rumor is there's going to be a partnership with Alphabet, which is Google, and that is going to require a lot of Apple users to refresh their devices. And that, again, becomes a big thing. Microsoft, #1 leader in cloud computing, and again, an area which is growing very nicely. They control about 30% of the market. Tesla has been mired in quite the slump so far this year. It's down 28%. But we've actually made a lot of money off Tesla so far this year. Why? Because we're able to write puts. The majority have been expiring, and we've actually made some pretty good money off Tesla. And hopefully it stays down here and we can keep accumulating some positions, because we believe with full self-drive and autonomy just right around the corner that this stock is going to be ready to do some explosive, to have some explosive growth in the years ahead. Now, this may be a bit of a challenging period of time, at least until August 8th when the full self-driving event happens. But we're in a pretty good spot. Meta, same thing. Meta is buying NVIDIA chips left, right, and center because they're integrating AI into all their platforms. If you use WhatsApp, you'll see it's there. So you're starting to really see how this AI thing is starting to play out. And right now, the market is really, really frothy, though. Everyone wants in on this, and we have to be patient here. Oftentimes, the best trade is no trade, and that's the approach we're taking right now. But like I said, we're still making some money. Eli Lilly has been on tear. We are a little bit underexposed on Eli Lilly. We look to get more exposure. Taiwan Semiconductor, we've got pretty good exposure there. It has had a really good pop, especially today. NVIDIA, this thing has just gone crazy. It's gone hyperbolic. It has crossed $3 trillion today. Market cap as of Wednesday, June 5th. It is now, I believe, as of today, or it might have been the most valuable company in the world, publicly traded. I believe it is just a shy hair, wee bit below Microsoft at this point in time. So this company's on a torrid pace. But valuations are getting a little bit stretched. Everybody wants in on this company, and it's really propelled this thing to at super high price. It's really gone up a lot, and we anticipate again a little bit of a pullback here. Airbnb, we have very little exposure to. We're looking to really add a little bit. The stock's done okay so far. We've done pretty well in the stock, but a little bit of exposure here. Bitcoin, we're right on track in terms of our 3% allocation. We will continue to buy Bitcoin post-halving, which occurred on April 20th of this year. Post-halving, after the Bitcoin mining is halved, the reward for mining each and every Bitcoin went from 6.25 Bitcoin down to 3.125 Bitcoin. And what that means is that miners have to work harder to make more money. And now the thing is, every time that you mine one Bitcoin, okay, and that's exactly what's happening right now, every time you mine one Bitcoin, there's a lot of compute power, a lot of electricity required to do that. So only the most efficient miners are going to survive out of this, okay? But if the value of each and every Bitcoin is worth that much more, let's say it doubles theoretically, well, then you're almost at the same, you're at the same level as you were when you were getting twice as much Bitcoin per mine, right? And if you look at the performance of Bitcoin post mining, it has done exceptionally well. So we're going to continue to accumulate Bitcoin here as much as we can through IBIT, and hopefully in anticipation of a very, very nice run up as soon as Bitcoin gets a bit more legs under it and people, more and more people join, the institutional investors, et cetera, are really joining and buying Bitcoin. All the ETFs that are involved in Bitcoin are growing very rapidly in assets. And there is a scarce amount of Bitcoin around. There's just not a lot of them around. There's 21 million Bitcoin to be mined ever. 94% roughly have already been mined. The remaining 6% will not be mined until 2140. So you got a long, long ways to go before that last 6% is mined. Now, keep in mind, 5 or 6 million Bitcoin is lost forever. That is people who lost their codes. They don't know, they don't know where the code is. That's gone forever. So really, you have an inventory of roughly 13, 14 million Bitcoin. And from all the Bitcoin people I've spoken to in the community, and thanks to Wasim and the conference that I went to in Montreal a few weeks ago, the majority of these people never plan on selling their Bitcoin in their lifetime. So the actual, inventory out there for buying and selling is very scarce. And if more and more people want to own Bitcoin through things like this ETF, there's only so many available. And we all know what happens when supply and demand are imbalanced. If demand far exceeds supply, well, that means the prices should go up. So we're really well positioned, guys. We're quite happy with how things have gone so far. Let's keep going. So our percentage exposure, this is either through long positions, and we don't have a lot of long positions, okay? As you can see, your exposure in stocks as a percentage of AUM, we're only at 26.1%. But if you look at how much we're exposed in terms of puts, it's at 87.2. And that does not count our cash position. We've got a large cash position, over 15%. And more money keeps coming in, okay? So we've got a lot of puts out there. We're experiencing a lot of decay. We've got some covered calls, and this is the time that you want to be writing covered calls. We're in the summer months. But unfortunately, a lot of these positions are being called away on us. We're not overly concerned because we believe that we'll be able to buy back in these positions at some point in time at a lower price once the market does finally have this pullback that is perhaps a little bit overdue, okay? So exposure in stocks, we're at 26.1%. We've collected 5.8% premiums as a percentage of AUMs. And actually, out of the money that we've exposed so far, 6.7%. So we've had a really good start. We're keeping the duration kind of steady around that 25, 30-day mark. Right now, we're at 26 days. So the portfolio has done well so far. And like I said, assets continue to come in every single day. Let's keep going. Now, again, we go over this every time. It's registered accounts are eligible for this. It's a higher risk portfolio. It's long-term. You have to have a long time time horizon because you're not buying into a GIC here or something like that. These are companies that are going to benefit tremendously from these upcoming technological changes. But that means it comes with a certain level of volatility. There will be ups and downs. Right now, there's lots of ups, but there will be downs as well, okay? And let's take a look. Actually, I want to go back to one thing here and just talk about exposure. You really want to be careful of how much you're exposing yourself to when the markets are running up like this. And the human nature is such that, chase the market. But you look at someone like Warren Buffett, the greatest investors of all time. They're patient. They wait. They wait for a pullback. And they wait for the prices they like. So we're going to be very, very adamant on sticking to the prices we want to buy at. We know there'll be a pullback. And more than likely, the higher the markets go, the more sizable that pullback will be. So we're going to just sit there. We're going to be patient. And we're going to wait it out. Okay? But in the meantime, we are collecting puts because we're writing options at prices we like. And that's allowed us to collect some pretty good money. So June is not considered a pretty strong month for the market, but it has been so far. Okay, June is not a good month at all traditionally and historically, but that's not 100% all the time. It is a odds and probability event that odds are June is not a good month, but this month may be an exception. So far it has been. The last few days of June are the start of the summer sizzler trade, because generally speaking, July tends to be a good month. And again, this may be opposite. We'll see what happens. We're anticipating some upcoming rate cuts we've already had one in Canada today. Tiff Macklin said there'll be a perhaps second one. They're open to a second rate cut in July. Who knows, maybe a third one in September and a fourth one in December. We'll see. But we already had one. They're open to more. And we're starting to get some bad economic data out of the United States, which means there could be some rate cuts coming in the US. And that is really kind of what's propelling the market as well. Another thing to take a look at is if you look at the polling data, the Republican Party is clearly in the lead. And because they're in the lead, they are perceived as the party that cuts taxes, makes it easier to do business. And if you combine that with a low interest rate environment or a lower interest rate environment, that is all good things for the stock market. So the stock market could be doing quite well for the next number of years. We'll see. But we're going to be disciplined and wait for the prices that we want to buy it. Okay. Our contact, actually, Matthew, you want to add anything here?
No, I think, Omar, you hit the nail on the head. Like the summer months, they're supposed to be choppy. They haven't been choppy. We've had a few days. We've had some red days, yeah, but like by and large, nothing crazy. Technically speaking, you could look at charts and you can, is there a case to be made that, things are fatiguing? Yeah, they are fatiguing, but that's, as option sellers, anyone who's an option seller, guys, like, volatility is their, high volatility is their best friend. So we have to just be very careful around that. When trading for ourselves and, obviously in the fund, we're also careful there. And we have to literally see how the summer goes, right? Like, and, it goes back to the old adage, the most important risk is the one that you don't identify, right? And I would not be surprised if that is the case. That is the catalyst, because like people, I've had a number of discussions with people to say, okay, so what's going to be the catalyst for the market moving down? So I don't know really, right? And sometimes that means it's going to be something out of left field that you do not expect, right? If you look at the big four macro indicators, guys, like interest rates, jobs, inflation, and GDP, there's nothing earth-shattering there. Maybe a little disappointment here, maybe a little bit too much, cheer on the other side, or too much good news. It's nothing crazy, right? And a lot of this is already old news. It's kind of as I say, baked in, right? So it is a tentative time, especially in the summer, and we're just monitoring the situation. I think that's about it.
Thank you. All right. As always, guys, our contact information is here. If you want to know anything about the fund whatsoever, we'd be more than happy to talk. Our phone numbers are here. Our email addresses are here. We cannot tell you how thankful we are to the Theta community and to all of our investors out there. We plan on doing wonderful things over the next number of years. Can't thank you enough for your support thus far. And the great thing is, like I said, we've recently become available at Royal Bank, RBCDS, and we are getting some advisors. And what I mean by this, let's say an advisor has a $300, $400, $500 million book of business, which is quite reasonable. In fact, I spoke to one a little while ago that has a $700 million book of business. He goes, I'd be happy to start off with 1% allocation to your fund, and then we could look at increasing it to 2 to 3% from there. That means between $7 and $21 million from one person. And what that allows us to do is allows us to keep averaging in and buying these positions on a dollar cost average basis is what we want to do, because this is not a 1 year thing or like a 1 day thing. This AI theme, cars driving around themselves, these are going to play out over a number of years. So you want to get into these positions at prices you like and then ride it out and enjoy all that upside, all the money that these companies are going to make, which means the stocks should propel themselves substantially higher from there. So if you want to get in touch with us, please do so right here. And as always, the obligatory disclaimer, this will be available on YouTube, so please read this at your leisure. If you have any questions or concerns, obviously you can contact Matthew or myself. We'd be happy to answer them. And again, like I said, guys, cannot thank you enough. We want to make these calls a little bit shorter and to the point. We will now take questions. Can't thank you guys enough. Really, really appreciate all your support. Matthew.